March 2020, the stock market is crashing, COVID just hit, everyone is terrified, and millions of investors do the exact same thing. They sell everything all at once, at the absolute worst possible moment. Here's what happened next. The market crashed 13% in 1 week. And then 11 trading days later, it recovered 19%. The people who sold, they missed the entire recovery and locked in a loss they didn't have to take. So why did they do it? Why do smart people sell at the bottom every single time? Okay, so here's the thing. When you see your portfolio dropping, your brain doesn't think financial situation. It thinks danger, like real danger. Your amygdala, the ancient alarm center in your brain, it fires the same signal it would if a predator was chasing you, fight or flight. Except you can't fight a stock chart, and you can't run from it either. So your brain picks the only option it sees. Get out, now sell everything. Stop the bleeding. That's not a financial decision. That's a survival instinct. And it's been running in your brain for 200,000 years. It just never evolved for the stock market. Now here's what makes it worse. There's this concept called loss aversion. Kahneman and Tversky proved it decades ago. Losing money doesn't just feel bad. It feels about twice as bad as gaining the same amount feels good. So a 10% loss doesn't feel like a 10% loss. It feels like a 20% gain would need to happen just to feel normal again. That's why watching your portfolio drop feels unbearable. It doesn't just sting, it feels catastrophic. Even when rationally the drop is temporary, and here's the cruel irony. The moment that feeling peaks, that exact moment of maximum panic, is almost always the worst time to sell. And then there's one more thing that pushes you over the edge. You see everyone else selling. The news is screaming. Your phone is sending alerts. Your friend just texted you saying he sold everything. And suddenly, selling feels like the smart move because everyone is doing it. Behavioral economists call this herding. Your brain runs a quiet calculation. Surely everyone can't be wrong. Except they can, and during a crash, they almost always are. So what do you actually do when the market is crashing? Nothing. Literally nothing. Fidelity once studied which types of investor accounts performed best. You know what they found? The best performing accounts belonged to people who forgot they had them, or people who were dead. Not because doing nothing is easy, but because the hardest financial skill isn't picking stocks. It's doing nothing when your brain is screaming at you to act. The crash of 2020 wasn't won by the people who sold fast. It was won by the people who sat still. If this changed how you think about your next crash, subscribe. Because next time we're breaking down why your brain lies to you about money.